Hey taxpayers, you know what's nice about the month of April, specifically the second half of the month? That's right, tax season's over, unless you file an extension. But what if I told you we can take this concept of tax season and we can split it into two separate seasons?
Oh Lord, there are two of them now.
That's right, we can actually have two tax seasons. You see, from the January 1st to the middle of April is our conventional tax season that we all know and love, and that's going to be reserved for tax preparation. Now, from the middle of April to the end of the year is going to be reserved for tax planning. But what exactly is the difference between preparation and planning? You see, anytime you get a W-2 or 1099 or whatever, that is going to be for everything that's happened in the prior year. It's stuff that's in the past. We can't change it. So that's why we have to file a tax return in order to reconcile if we are due more tax or we get a refund or whatever. But if we're not satisfied with our tax preparation results, then we can do tax planning in order to change things to our benefit, which is obviously very important. So the little example I like to give is, preparation is everything that's happened in the past. We can't really do anything about it. So everything that's tax preparation related is your rear view mirror. Again, it's in the past. But tax planning is your windshield. It's everything that's in the now, in the near future, and so forth. Things that are actionable, things that we can change in order to, again, benefit us as taxpayers. But how do we tax plan, you may ask? Well, that's a great question because the best answer is going to have to be tailored to your specific needs. But what if we can take a tax planning strategy and mass produce it? Well, that's kind of what we're going to do here. Because one of the best, most impactful ways of tax planning for a good chunk, if not majority of the US tax-paying population, is simply just, well, updating your W-4. I know, I don't know how to make that sound more sexy, but again, it's just updating your W-4. But what exactly is a W-4? Well, chances are you only see W-4s whenever you take a new job with a new employer. Now, I do stress that new employer part of that equation because let's say you worked for the same company for 20 years, but you've taken new jobs within that company. Maybe you got promotions, maybe you got demoted, maybe you moved laterally to different teams or whatnot. But as long as you worked for the same company, again, in this example for 20 years, the last time you probably saw a W-4 was 20 years ago. So generally people only see W-4s whenever, again, they take a new job with a new employer, or maybe there's a payroll system update, like they switch payroll providers, or maybe the company that you worked for was bought out, so you're still technically working for the same company, but as it goes under a different name, and those usually require new W-4s as well. But again, W-4s aren't something that people just see all the time. Now, even though you can go up to your HR department and just say, hey, can I request a new W-4? And they should give it to you right then and there. But again, people usually don't do that. So what exactly is a W-4? A W-4 is used to estimate your tax withholdings. But here's the big thing. We have to realize that your tax withholdings is not the same thing as your tax liability. You see, your withholdings is like an estimate or a pay-as-you-go that goes against your tax liability over time. And the reason we have tax withholdings is because, well, it helps ease the burden of this tax liability over time. So for example, let's say you're a taxpayer and your tax liability for the year comes out to, let's say, $6,000. Now, would you rather have that $6,000 tax bill all at once, or would you like to pay roughly $500 a month, again, throughout your paychecks in order to knock that down? Well, chances are you're probably going to say, well, let me just pay it over time. And well, that's why we have tax withholdings, is because again, you're taking a little bit of your tax and you're going to pay down your tax liability, which again, kind of helps not feel as gut punching when you're paying it over time. And then we have to file a tax return in order to reconcile, okay, did we overpay our taxes? Oh, then there we go. We get a refund. Or in the opposite world, oh, we didn't pay enough, now we owe. So here's where it gets really important. If the W-4 is just there to estimate your tax withholdings and has no bearing on reality on what your actual tax liability is, then the W-4 actually serves as a very important pivot, a pivotal pivot, as you may say, between the amount of your potential refund or the amount that you owe versus the size of your paychecks. So let's say that you are just dead set on having a large refund. Well, in order to do that, generally what you have to do is overpay, which means that your paychecks are inherently going to be lower than they otherwise would have been. Because at that point, you're really just getting your change back. Let's say hypothetically your tax liability came out to $10,000, but your withholdings actually came out to $12,000. Well, in that case, you overpaid by $2,000, so guess what? Your refund is, again, that $2,000, all other things held equal. Now, obviously, the exact opposite is true. What happens if you find out you do your taxes and you find out that you owe we don't like owing. But also by the same token, we need to know that on the other side of the seesaw, your paychecks were higher than they otherwise could have been. So for example, if you've ever seen yourself in this scenario, I just did my taxes, I only got a $200 refund. My friend makes the same amount as much as me, and we have the same amount of kids, and he got $4,000 back. Obviously, this is wrong. Well, according to our pivot, if that situation's you, your refund was lower than what, again, other people's was, meaning that your paychecks were probably higher than, again, those other people that you're comparing to. So as your homework assignment, if that's you, then, well, try and go ahead and compare your paychecks again against someone that probably got a higher tax refund than you. Chances are, again, everything else held equal, like again, the same amount of salaries and kids and whatnot, chances are it's just this difference in the size of your paychecks. Or if you've ever seen yourself in this scenario, I just did my taxes and I owe $500. Why would I owe $500? I pay taxes out throughout the year on my own wages. So yeah, if you find out that you owe taxes whenever you finish your tax return and you tell yourself, wait a minute, I pay taxes all throughout the year. Why would I owe more? Well, that just means that you just didn't pay enough. So again, that comes to tax planning. If we know that we owe X, but our withholdings only came out short, then that gap is what we're gonna owe, again, on our tax return. But here's the situation. What's the optimal way? Again, this is where it can get pretty confusing because see, if you have two people who make different levels of income, chances are their W-4 strategy is not gonna be equal. And taking it a step further, if you have two people who make the same amount of money, same thing. They're probably not going to be equal in how they want to strategize how they do your W-4. You see, some people want the highest refund that they can possibly get because sometimes they see it as like a forced savings distribution or something. So if somebody knows that they're usually going to get $6,000 every year when it comes to their tax return, then maybe that's how they want it because they want that extra money. But again, obviously the downsides of it is generally whenever you get such a large refund, it's going to be at the cost of having lower paychecks because again, you're overpaying. And by the time you get your refund, you're just getting your change back. But see, sometimes people want to use this as a strategy. They don't want a large tax refund. Sometimes people want to owe. Again, it's a little less conventional, but some people actually want to make sure that they owe something in order to have higher paychecks. Now, these people are usually a lot more risk tolerant. So these people maybe certain types of gamblers, professional gamers or whatnot. But more importantly, what they usually will try to bet on is if the amount of their paychecks, again, that extra amount that they could have went to withholdings, if they can get a higher return than the potential penalties and interest for owing, then they actually come out ahead. And again, it's usually not, again, the most conventional way. People aren't usually going to be, shoving this strategy down your throat. But again, some people they do well with it and, more power to them. So what is the proper way of filling out a W-4? Well, hopefully by now we would understand that these extremes are probably not ideal. Yes, we would love refunds, but we really don't want to have to sacrifice our daily, monthly, however, much you get paid. We obviously don't want our paychecks to go down more than they need to. By the same token, we obviously would like to have more paychecks or more money in our paycheck, but we obviously don't like owing taxes, especially if we aren't planning for it and we get surprised. So usually the consensus is that the proper way to fill out your W-4 and your tax strategy usually is to balance between the two and really not have much of a refund at all. That's right, the balance between these two is generally considered the optimal way of filling out your W-4 and doing your taxes, which is kind of a hot take. You mean people really don't want much of a refund? Like a $0 refund, breaking even? Can you imagine a tax preparation office actually advertising that? No, because they all advertise, we get you your max refund and whatnot. Because guess what? It's a marketing gimmick. So yeah, this is an unpopular opinion, but a tax person that is going to work with you generally does not want you to have large refunds. I know, it's shocking revelation, right? Now, personally for me, if you make under 1% of your income in a form of a refund, that's usually where my sweet spot is. I usually don't like people owing anything because again, no one likes owing more taxes. So if you can get within 1% of your salary, so for example, if you make $100,000 and your refund is less than $1,000, I consider that a win. Now, once you start getting above 3%, that's usually when I kind of step in and say, we need to maybe change a few things. Again, assuming that the refund is driven by over withholding, because personally and professionally, I like to see you have more money in, again, each of your paychecks in order to use, well, for your daily lives. So now taking it a step further, let's kind of give you a real scenario. Let's say you actually consistently get a $3,600 tax refund year after year, and $3,600 is usually around the national average. Now, that sounds like a lot of money, and it is for a lot of people. But what if I told you if we change your withholdings, we brought that refund down to zero? Ugh, I know I lost some people there, but you actually gain an extra, what, $300 a month, again, by getting that refund sooner through the paychecks, right? Remember the pivot? If we brought your refund down from $3,600 to zero, your paychecks go up by, let's say, again, roughly $300 a month. But what if I told you you can take that extra $300 a month and do something that's tax advantage, like put it in certain like qualified retirement accounts, if you itemize doing charities or whatnot. So actually you can take your $3,600 refund you could have gotten and use it to do more tax advantageous things. So not only do you get your $3,600 sooner throughout the year, but you can also turn it into an additional refund. So your $3,600 refund becomes not only money that you get today, well, I guess per paycheck, excuse me, not necessarily today. You get your $3,600, throughout your paychecks, but you also turn that into a tax refund because, well, you use that $3,600 to do some sort of tax advantage thing. Again, pretty smart. So there you have it. The proper way to fill out a W-4 is to aim and have the goal of having such a small refund that it doesn't actually serve any type of purpose. You see, just enough to say, okay, well, I got something back, but not enough to make it actually worthwhile or actually something that you had to wait for. So for example, if I ever hear stories of people waiting for their tax refund in order to, pay rent or whatnot, that's kind of a problem because again, my next question would be, if you're over withholding that, then let's change it because again, we shouldn't have to rely on a tax refund in order to live. Now, with all that information out of the way, let's actually look at a W-4 and actually walk through one in order to understand exactly how to fill them out. Now, again, the proper way to fill them out is to, well, mimic what your tax return would look like. Because again, if our W-4 mimics what our tax return would look like, then that's going to generate a very small, if any, type of refund. But we won't really generally owe. So again, this is going to give us to what we'll call the break-even point. Again, remember that level I had? We want to have a balance between the potential refund and the amount of our paychecks. We don't want one side taking over the other. We want them to be equal. Now, I will give the IRS some credit, which is something I don't say very often. The new W-4s that they have here are actually pretty good. Now, even though they are still pretty confusing, there are some things that I really wish they would clean up, but again, they didn't ask me. But if you're with the IRS and would like to talk, hey, me and my colleagues have some suggestions for you. These new W-4s will actually help taxpayers in order to get to a, again, minimal tax refund in order to optimize their paycheck amounts. Because if you remember back in the day, people would say things like, well, always file single and zero when it comes to your W-4 in order to optimize your tax refund. Well, filing a single and claiming zero has not been a thing for a few years now. So again, this is the new way, at least for now. We'll see how things change up in the near future because who knows what tax law is going to look like. So again, here's a W-4. And like I said at the beginning of this video, you only see these whenever you take a new job with a new employer. So if you work for the same company for 15 years, chances the last time you even saw this was 15 years ago. Now, obviously for step one, pretty self-explanatory, just enter your information. But C, that part there in step 1C, that's actually very important. You either select single, married, filing jointly, head of household, or whatever. You generally want to choose exactly the one that is you're going to file on your tax return. So if you're going to file as single or married filing separately, click that checkbox. If you are married and you're going to file jointly, click that checkbox. If you're single and you have dependent children for which you maintain the cost of the household for, that's head of household. But at the end of the day, we want our W-4 to match what our tax return is going to say. Because see, back in the day, what people would do is if their tax return was technically going to be married filing jointly, they would file as single on the W-4 because that would boost their withholdings, which guaranteed inherently a higher refund. Now, yeah, I guess you could technically do that here, but again, our strategy, the optimal way of doing this is to make sure that our W-4 matches our tax return. So again, if you are married filing jointly on your tax return, go ahead and put married filing jointly on the W-4 as well. Unless, again, if you want to go ahead and file as single under W-4, even though you are technically married filing jointly on your tax return, that way it withholds more. But again, we'll kind of get into why we probably don't want to do that because there's another step further down that actually kind of counteracts that. Now, this is where the W-4 gets pretty easy because let's say you're single, you don't have any kids, this is your only job, and well, again, like I just said, this is your only job. Well, at this point, you're done. Just sign it. That's it. So if you, again, single with no kids, all you have to do is fill out your information up on top. You just select your filing status, which again, single in this situation. Claim, or step 3 here, since you're not claiming any kids, that'll all be blank. 4, we'll kind of get into a little bit here, but again, for quite a few, again, a good chunk of taxpayers who, again, are single and don't have kids, this is their only job. You just fill, again, section, the top section out, sign it down here, and you're done. But that's not always reality because, again, people get married, and now more than ever, people have multiple jobs. And that's where step 2 comes into play, because step 2 is actually very important. And the sad reality is it can get confusing very fast. So we want to look at step 2 as the total amount of jobs in the household. So again, if you are single, but you have 2 jobs, 2 W-2 jobs, then we want to use step 2. If you are married and each of you have 1 job, that's still 2 jobs in the household. So again, we want to look at step 2. Now, if we want to take it a step further, where again, maybe you're both married, one of you has 1 job, but the other spouse has 2 jobs, well, we'll get into that in a little bit. So again, step 2 is really going to be used for only if there are multiple jobs within that household, whether you're single or not. Now again, I'm going to give the IRS some credit because if we look at the steps and instructions here for step 2, if we look at point A, it talks about the IRS withholding estimator app. And actually this works pretty well. Again, it's been a while since I personally used it, but I know people who've used it and actually said pretty easy things about it. It was easy to navigate, it was more concise, and it was actually a pretty spot on thing. Now, I won't be using the estimator in this video, but again, I've been hearing some pretty, again, positive things about it. People usually can get through it pretty easily and not, get stressed out about it. So that's a win in my book. Now, I am going to jump down to point C here because, again, I'm going to give the IRS credit because they kind of explain it pretty well here. But if you were to say you as an individual, a single person, have 2 W-2 jobs, or you're married and you both have a single W-2 jobs, each of you have 1, you can usually go ahead and use part C, which basically says that, hey, the lower paying job between the 2 of you, if it's more than half of the higher paying job, so for example, if one spouse makes $100,000 and the second spouse makes at least $50,000, you can use point C, where it basically just says use the check this box, and that's it. Pretty self-explanatory. Now, I am going to jump back to part B because this is usually what I look at. I really haven't seen a whole lot of fluctuation between people who do point C and point B, but point B is pretty important because, again, that's going to give us kind of like our table lookup that's going to tell us, hey, what should the amounts be given the range of salaries that each job pays. So for example, here is a snapshot of page 4 of your W-4, and it's basically just a bunch of numbers, and it's a table. Now in this case, we're actually assuming that we're married filing jointly. That means that we as one spouse has a job, and the other spouse has a job. Now for this example, let's say that one spouse, the higher paying spouse, has a job that pays $100,000. So what we're going to do is we're going to go along the column here and we're going to find $100,000, which I already have highlighted. Then we're going to look at the second job, or again, the spouse job, and that's going to tell us what their salary is going to be. And since this is for the lower portion, we obviously are going to expect it to be less than $100,000. And in this case, let's assume it's going to be $50,000. So in this example, one spouse makes $100,000, the other spouse makes $50,000. Again, we just find it on the columns and the rows, and we find the intersection between those, which again is circled there. And that tells us what step 2 is that we're going to have to plug into. So jumping back to page 3 of your W-4, that intersection of those 2 numbers we just found shows up there in box 1. And if, again, that's the only jobs you all have, then there we go. We're done with this. But we can't ignore reality here because let's face it, inflation was crazy for the past few years. So even though we have a married couple, one of them may be working more than 1 job. So again, one spouse may be working 1 job and another spouse is working 2 jobs. And if that's the case, we need to look at step 2 here, which basically says, hey, we need to look at 3 job situation. So in order to do a 3 job situation, we actually have to do the same thing we just did, but we actually have to do it twice. And also, I don't think I mentioned this, but if we looked at this table that we just looked at a little bit ago, we're looking at the married filing joint table. So in this situation, let's say, again, one spouse makes $100,000, the other spouse makes $50,000. We find this intersection between the 2. But let's say you are a single person that just happens to have a $100,000 job and a $50,000 job. Well, you're going to do the same exact logic, but you're not going to be on the married filing joint table. You're going to find the single table, which I have just cut off down here. So again, just make sure you're looking at the correct table that matches your filing. So going back to the 3 salary situation I just talked about, again, we have one spouse that maybe has 1 job, the other spouse has 2 jobs. And again, in order to do this, we actually have to layer it. So again, same situation and same scenario that we just looked at. Let's say we have one spouse that makes $100,000 and there's another job that pays $50,000. So we're gonna do the same thing. So there we go. We find that 9930 is the intersection. So we're gonna write that down in step 2. But now we have to take into account the third position. So in this case, we just found out the intersection of the 100,000 plus the 50,000. We added them together, and then we find that 150,000 here in the rows. Again, we're still looking at the married filing joint table. So again, if you're single or head of household or whatever you use, obviously you just need to look for your specific table. But in this case, we just found the intersection of the 100,000 and the 50,000. Now we got to find the intersection of the 100 plus the 50,000 to the third job. So obviously, generally speaking, the third job is going to be paid less because, you know, it's maybe something that they do over the weekend or the summer. Maybe you're a teacher and this is something that you do over the summer, you know, whatever the situation is. But see, now we take the $150,000 that we just found the intersection for, again, prior, but now we are going to intersect it with the third job. In this case, let's say it's 20,000. So again, same situation, we do the same thing. We find 6640 is the intersection, and that is going to show up on box 2B of that step. So again, coming back here to step 2, when we have 3 jobs, again, box 2A is going to be the intersection of the 2 higher positions, which in this case was the $100,000 and the $50,000 example. We find the intersection there. Then when we jump down to 2B, we add the 100 and plus the 150 to get 150,000, and that is going to intersect with the third position, which is again, which we said was 20,000. And that intersection is going to be what we put into 2B. And at that point, 2C is just the sum of 2A and 2B, pretty self-explanatory. And 3 is going to be the amount of times you're paid throughout the year. So if you're monthly, it's 12. If it's bi-weekly, 26. And finally, step 4 is basically just another math function. You're basically taking the amount in 2C, which is the sum of all those intersections that we found out. And then we're dividing it by box 3, which is the amount of your paycheck occurrences throughout the year. So again, 12 if you're paid monthly, 26 if you're bi-weekly, and so forth. That's going to give you an amount in box 4. And at that point, we're pretty much done, assuming that, again, that's all you had in terms of income. Now that we're done with step 2, which is generally considered the more difficult one, because again, you have to figure out who makes more versus what and what the intersection of the 2 are, and then add them together. And if you had a third job, you got to, you know, find another intersection and add them up together. So again, sometimes step 2 is usually going to be the most confusing. But again, hopefully that all made sense, because now for the rest of this, video, it's actually going to be pretty straightforward, because step 3, on the other hand, is pretty self-explanatory. You see, we have what's known as a child tax credit, which is currently $2,000 per kid, as long as they're under by the age of 17. So if you are single or married, doesn't matter, and you have 2 children that you are, they qualify as dependents, then you are going to put, 2 in this first line. And again, since each child is worth $2,000, that's an additional $4,000 potential credit that's going to go against whatever we need to withhold, because again, that's not something that we're going to pay tax on. And if you have kids that are age 17 or above, or you have other types of dependents, then we, instead of doing the $2,000, we do the $500, which is again, that's second line there. Again, pretty basic math. Again, we just add them all up together, and that gives us box 3. Again, pretty self-explanatory. Now bear with me because we're almost at the end, but step 4 can usually be a little tricky. Now starting with step 4A, basically this says, hey, if you want to enter in any type of other income that you have that's not subject to withholdings, you can go ahead and do that here. Usually this is going to be subject to things like dividends and interest that you can usually earn, but that are not going to generally going to have taxes withheld. So again, if you earn a lot of interest or dividends or whatnot, you can go ahead and list the amount there in box 4A, and they'll go ahead and withhold the appropriate, again, withholdings against it in order to not be, again, surprised. Now, step 4B is for people who generally don't take the standard deduction, and or they take what is known as above the line deductions. So things like student loan interest, HSA deductions, and so forth. Now, what's interesting about 4B is if you are actually one that actually itemizes, you could probably potentially go ahead and say that you just take the standard deduction on your W-4, because again, itemizing at that point would be beneficial if you are able to itemize more than the standard deduction. But again, that's going to be something that's reflected on your actual tax return. And since we talked about the W-4 best being reflective of what your actual tax return is, again, if you take the itemized deductions, but you go ahead and just report the standard deduction on your W-4, that means you're generally going to have more withheld, which again inherently means that you're going to have a little bit of a potential extra refund, which again is usually more for a conservative approach if you want to, be less risk averse. But again, completely up to you. But if your itemized deductions and so forth are so much more significantly higher than what your standard deduction otherwise would have been, I'd say go ahead and fill out 4B accurately. Otherwise, if your itemized deductions are just marginally above what standard deductions are, usually you can probably be a little bit safer. Just say, hey, not even filling this out. That way, again, inherently, you're going to have a little bit more withheld. Not much, not material, not significant, but just enough to say, okay, you're going to have a little bit more withheld in order to just, again, play it safe. And here's a breakout of those deductions that are available. Like I said, for that step, people usually only do it if you are going to be itemizing. And again, if you're going to take the standard deduction anyway, chances are you probably won't even look at this. But again, it's just something to note because again, in this case, $30,000 was the standard deduction for mailing, filing jointly, which again, this was for 2024, which again, 2025, it should go up. But let's say your itemized deductions were just marginally above it. In that case, you could probably go ahead and just say, either fill this out correctly or just leave it blank. You shouldn't have any big issues. But if your itemized deductions were say 100,000 plus, again, against a $30,000 standard deduction, I'd go ahead and fill this out just because we don't want to way over withhold than what we need to. Again, it all comes down to finding that balance. And again, step 4 is your above the line deduction. So whether you take the standard deduction or not, line 4 here are deductions that everyone's entitled to, which again, I said certain types of retirement contributions, your student loan interest, your HSA, not deductions, excuse me, contributions, again, are things that anyone can take, again, whether you take the standard deduction or not. So again, if you are eligible to take any above the line deductions, you want to make sure that they are also accounted for here in box 4, because again, it just helps you out a little bit more. But generally speaking, people probably won't have to fill this out. And again, if you go ahead and leave it blank, that just means inherently you're going to have more withheld, which again gives you a little bit more extra cushion just in case things go wrong. And last but not least is step 4C, which is arguably my favorite part of the entire W-4, because we can use this step to fine tune and get exactly where we want our tax strategy to be. So for example, let's say you do want a little bit of a tax refund and everything we just did prior to this, up to the step would pretty much get us nothing, but maybe we want a little something. So let's say hypothetically, we want to use step 4C in order to boost, again, give ourselves a little conservatism. Now, what 4C does is it takes the amount of whatever you put in there and has it additionally withheld for each paycheck, depending on, again, the frequency that you get paid. So example, let's say you put $100 in that step 4C and you get paid monthly. That means that you're going to have an additional $1,200 withheld because, again, it's going to say whatever amounts in 4C there is going to be taken out per paycheck. So in this case, if you're paid monthly, that's 12. But more importantly, I use step 4C in order to get people fine-tuned so they don't have to owe. So let's say hypothetically you did your taxes and you find out that you owe $2,600. Ugh, that's not a very fun conversation to have, but what can we do to change that? Well, if we go to our W-4 here and say, well, we don't have to worry about everything else. Let's just go ahead and jump to 4C and say, I just want an additional $100 withheld per paycheck because I'm paid bi-weekly. And again, the example I just gave was someone owed $2,600. And if you're paid bi-weekly, that's 26 pay periods during the year. If we have $100 additional withheld per paycheck, that comes out to $2,600. So in theory, once we have this whole thing set up for a whole year, that $2,600 that we generally would owe is completely wiped out, because we can use this step 4C to, again, fine-tune exactly where we need to be. Now, another classic example is, let's say you just did your taxes and you found out that you owe $1,000 and you weren't expecting it, so it came as a surprise. You're obviously not happy, but what can we do in step 4C in order to, again, make sure that this doesn't happen again? Well, again, let's just say you just did your taxes, you get paid bi-weekly, which again is 26 times a year, but obviously, we don't want to put 1,000 divided by 26 in that number because, again, that's going to be for an entire year. We just did our taxes, so maybe we're already partially in through the year. Now, but maybe we calculate, we have 20 payments, we have 20 pay cycles, 20 paychecks left for the year. And again, I don't want to owe $1,000. So what we could do is take that $1,000 we would have owed, again, potentially next year, divided by the remaining paychecks of the year, which in this case is 20. So we want to put the number 50 down here in box 4C. What that does is it's going to go ahead and it's going to take an extra $50 of withholdings per paycheck for the rest of the year, which in this case is 20. 20 times 50 is $1,000. So all things considered, generally speaking, again, if everything else is consistent year over year, we're not going to owe $1,000 next year because, again, we already had an additional $1,000 withheld. Now, taking a step further, once we get into the new year, we'll have a full year impact where, again, all 26 payments during the year will have an additional $50 withheld. So not only are we going to have the original $1,000 of potential downfall that we usually have covered, we'll have an additional $300 of cushion when it comes to potential refund, which again, $300 as a refund is relatively small and just enough to make sure that, again, if anything was to happen that was not in our favor, hopefully would clear it up and, well, we wouldn't have any nasty surprises. So there we have it. A lot of information for a relatively simple form. At that point, just sign and give it to your HR people, and that's really it. And anytime you want to update your W-4, you just go hit to your HR payroll people and ask for it, and they should give it to you. So anytime you think something's not right, you are having large tax refunds or you're owing, and that's not something that you want, and you want to get to that balance where, again, you don't have a large tax refund or at least a very insignificant one, well, just update your W-4 because, like I said, your HR people should give it to you at request. So again, just update it to what you need to do. And hopefully, again, that'll get you right on track. So hope all this helps.